Let me paint you a picture. It's been a tough couple of years, but things have been looking up lately. Inflation is cooling, interest rates are falling, employment is holding steady. But weirdly, more people in Canada are missing payments on their loans.
We're seeing more consumers getting themselves into financial stress, and that's a little bit concerning for us.
In Ontario alone, 11,000 people missed a mortgage payment last quarter. That's 3 times as many as 2 years ago.
That's a sign that there's so much stress in the system that it's starting to burble up.
So, what's going on? I'm going to start by saying some bad words. Mortgage delinquency rate. Equifax recently tracked how often people were missing mortgage payments for 90 days or more. This delinquency rate almost doubled in Ontario year over year, and it jumped around 40% in both BC and Quebec. But why? Haven't mortgages done nothing but get cheaper over the last 9 months or so, as interest rates keep going down and down and down? Well, you'd think yes, but in a lot of cases, no. Because let me ask you this. What year in all of Canadian history do you think saw the largest number of mortgage contracts being signed? The answer is very recent.
2021 was the biggest mortgage origination year in the history of Canada.
2021. And if you were part of that very large cohort of homebuyers in 2021, you know exactly why you bought or renewed when you did. In 4 words, you bought the dip. Interest rates were at an all-time low. You saw opportunity. And while the pandemic locked everything down, you locked in.
While everything else shut down, real estate activity's been off the charts.
They called it Real Estate Christmas because it was the most real estate sold in the history of the country.
But here's the other side of the coin. What comes down must go up. The most common mortgage term length in Canada, so how long your contract runs for until you have to renegotiate, is 3 to 5 years. So let's roll the clock forward in time for all those folks who picked up mortgages in 2021. 3 to 5 years from that point lands you somewhere in this range for renewal, 2024 to the end of 2026. And turns out more than 3/4 of all mortgages in Canada as of early 2024 fall within this window, a renewal date that has snuck up faster than people might like. Now, like I said, interest rates have come down since 2023, but they haven't come down to 2021 levels. They're not nearly as low as when this cohort we're talking about signed or re-signed their mortgages a few years ago. And every percentage point can make a big difference. Let's say you bought a house back then for $800,000 in Ottawa, and you put 20% down, you lock in for a 5-year fixed mortgage at 1.5%. Killer rate. Your friends hate you. Your monthly payment at the time might have been just under $2,600, we'll call it $2,588, and let's say that was right at the top end of what you can afford. A year later, when interest rates start going up, you're feeling pretty smart because your low rate is good for 5 years, but interest rates keep climbing. And only in the last 9 months or so are they starting to drop. Problem is, you are up for renewal. And the lowest rate you can get is 4.5%, which means you're now paying closer to $3,000, let's call it $2,936 a month, or if you do the math, about $350 more than you used to.
So for those people, when they renew, the shock from those payments could be dramatic.
And there's something else to consider here, that the average balance on mortgage renewals in 2024 surpassed those in 2023 and 2022. What does that mean? A bigger balance means, on average, people in this buying frenzy cohort took out bigger loans to buy more expensive homes, homes that they may or may not have been able to afford otherwise.
When the bank rep comes to you and says, you're eligible for a $350,000 mortgage, the home buyer said, great, I'll take it. Maybe not realizing that they could have pushed back and just said, I know that I qualify for 350, but I only want 275. Or what would happen if interest rates rise to generationally high levels? What would happen to my mortgage payment when I have to renew in 3, 4, 5 years? And that conversation might have gone missing.
And there's a domino effect here, because while more people than before are missing their mortgage payments entirely, especially in Ontario, there's another set of people who are still making their payments, but perhaps at the expense of everything else.
The last thing you're going to mess with is your mortgage payment. Canadians are pretty sacrosanct about that. They'll jump through giant hoops to try to make sure they can pay their mortgage. It sometimes means maybe going bad on your car loan or your line of credit or your credit card payments. That's where people can really get themselves into trouble.
Which brings us to the next part of this story, a significant rise in other types of debt. Let's look at credit card spending. If we make this comparison between 2024 and 2022, we can see credit card spending hasn't really changed much in 2 years, but the overall balance on those credit cards has gone up pretty significantly in that time, about $600 a month on average. Some of this is on account of taking on new debt. Some other part of this, according to Equifax, is from making only minimum payments or missing payments altogether. In Q4 of 2024, 3.6% of credit card holders missed payments for more than 3 months. That's up from just under 2.4% in the same quarter in 2021.
In terms of kind of the change that we've seen, so not just mortgage delinquency, but also other types of delinquency or missed payments on things like credit cards and loans, it is rising at a fairly quick rate.
This applies to all non-mortgage debt. So car loans, credit cards, lines of credit, student loans. And when you add all of that debt together, it amounted to about $22,000 per person in Q4 of 2024. Add back in the mortgage debt, and Canadians now have a total of $2.56 trillion of debt.
That's up around 4.6% compared to 12 months ago. And really a lot of that growth is coming from non-mortgage debt growth.
There are a couple of factors at play here. One being all those people we just talked about, renewing their mortgages at higher rates. Because if your top priority is paying your mortgage, and your mortgage is now a few $100s more a month, you might not have much choice but to skip a few payments on your credit card or car loan.
A lot of these first-time home buyers, a lot of low-income Canadians that maybe got onto the housing market at the wrong time are relying on excessive amounts of debt.
Also, they have a mortgage, it's high balance, it's maybe coming up for a renewal. We're seeing their credit cards, their loans, missed payments on those sorts of products starting to increase as well.
But it's worth underlining here, the younger you are, the more likely you are to be in this problem group, whether or not your mortgage is up for renewal. Because for you, in the first place, the cost of housing has gotten so out of control.
There really are two economies in Canada, and the people that are in that upper group that own a home outright, or own a home that they bought before 2014 and prices really started to go crazy, they're in such a different financial position than almost everybody else.
Here are the delinquency rates for Canadians, setting mortgage debt aside. Q4, year over year. You can see for people in their 20s, 30s, and early 40s, we're talking increases of more than 20% on missed payments. The cost of housing is just a big part of that, but so is the price of everything else.
Yes, the rate of inflation has dropped, but prices are up considerably from where they were pre-pandemic, and that's eating into people's budgets. It's all of the stuff that you pay day to day, week to week, month to month that are just adding up, and they're burbling over.
And generally, what you hope for in a healthy economy is for wages to keep pace with inflation. But for many young people, they haven't.
If you look at the actual StatCan data, you'll see they show that wages have caught up to inflation. But that's in aggregate. It's looking at the really big picture. If you zoom in on those younger, on those lower income Canadians, inflation is still massively outpacing their wage growth.
My generation grew up on a rule of thumb where you spent about a third of your income on housing. Now we're seeing that it's 40 to 50%. And anecdotally, you're hearing in Vancouver and Toronto that people are spending upwards of 90%. It's not necessarily even because they took on too big a mortgage. If housing prices are rising faster than your wages, then more and more of your income is going to have to go to it just to make ends meet.
Now you might be wondering, is there any good news in all of this? Well, sure. For starters, the vast majority of Canadians do continue to make their payments on time. Overall delinquency rates are still very low. They've just jumped from a very low rate to a higher low rate, if that makes sense. But also consider anyone on an adjustable rate mortgage that rides the interest rate in real time. When rates go down, they get relief right away. They're happy right now. If you live in places where homes are more affordable, most provinces outside of BC and Ontario are actually, on average, doing pretty well. And for those who are still sitting on the sidelines, waiting to get into the housing market, there will likely be more rate cuts to come. But there's also a lot of economic uncertainty on the horizon. I'll show you one more graph. These bars are how many mortgages are up for renewal each month in this country. Right now, we're here. All the other bars after that are how many mortgages there are to go, all the way to late 2027, when things are finally projected to settle down a bit. All of those people between now and 2027 are likely watching interest rates very, very closely.